Li Auto is currently on the third place, just behind the startup competitors Nio and Xpeng. Then recently announced the expectation to deliver fewer cars than Nio has been delivering. Li Auto's only vehicle, the Li One, comes with a fuel tank for charging the battery, making it a hybrid electric vehicle. Although the company delivered fewer cars and shares dropped over 10%, Li Auto has a major leg up on most of its competitors as it has moved beyond the proof-of-concept stage. With its initial rollout of Li One and rapidly rising deliveries, Li Auto is well positioned to be a major player in the EV space. Before we get to the video, please share your thoughts in the comments and use the thumbs up feature. It would help YouTube suggest the correct videos to you and help the channel to understand your audience. Feel free to subscribe to always get our latest videos. This video will go over the following topics regarding Li Auto and their stock. Timestamps are provided in the description in case you feel like going faster. Company background: Li Auto was founded in 2015 by CEO and Chairman Li Zhang, based on whom the company is named. The company designs, develops, manufactures, and sells premium smart electric vehicles. Though innovations in product, technology, and business model, the company provides families with safe, convenient, and refined products and services. The company has vehicle manufacturing, engineering, and design services located in Shangzhou, Jiangsu Province, with corporate headquarters and R&D facilities in Beijing. The company leverages technology to create value for its users. It concentrates its in-house development efforts on its proprietary range extension system, next-generation electric vehicle technology, and smart vehicle solutions. Li Auto, which is primarily based out of China, is poised to be the direct beneficiary of China's rapidly growing EV market. China's expected growth in the EV market for 2021 is projected to reach 1.8 million units. Competitive environment. Since 2016, China has been the fastest-growing market for electric vehicles in the world. The EV space within China is extremely crowded. The Chinese government quickly responded with support and jumped on the opportunity to become a global leader in automotive production. Tesla also saw potential and built their factory in Shanghai in mid-2018. According to a study conducted by the Center of Strategic and International Studies, China has invested over $60 billion into facilitating EV R&D, providing tax exemptions and financing battery charging stations. There are over 400+ Chinese companies competing to capture the share of the EV market. China's policy and desire to have homegrown companies turn into national champions that can compete on the world stage has incited fierce competition amongst the Big Three, and Li Auto currently sits in the middle of the pack, behind Nio but ahead of Xpeng. As such, leveraging an expanding physical footprint of 60 stores, autonomous tech development, and elevated demand could see Li be the first of the three to reach profitability as early as the current fiscal year. The technology edge. Li Auto's partnership with NVIDIA in September will be crucial to its long-term success. For self-driving chips, the company currently uses Mobileye, but will shift to NVIDIA Orin chips in the future as it offers greater flexibility and control. The company also wants to focus on building the software for NVIDIA Orange chips first before developing its autonomous technology. Since Li does not offer the highest-end specs, technology advancements like an R&D center for high-voltage platforms, fast-charging technology, next-generation intelligent cockpits, operating systems, and computing platforms could be the key to drive sales in its core price segment. The business. With the creation of Li One, the company has developed the brand around a single product. Released in November 2019, Li One has already become the best-selling e-SUV in China. By targeting a niche market for families and keeping manufacturing in-house at its factory in Shangzhou, China, the company significantly reduces operating risks. While manufacturing can be costly at first, it will also lead to controlling costs at scale, more flexible designs, and lower communication barriers between different departments. The Li One is an effective SUV for large families in China, priced competitively at CNY 328,000, approximately $50,000, with a range of 800 kilometers and a 40.5 kilowatt-hour battery. Buyers of Li One can enjoy many advantages, such as an easier way to get an NEV plate, which is extremely attractive for many families in Tier 1 cities, government subsidy, and lower costs brought by EV charging and convenient use when switching to the gas mode. Unlike most other electric vehicle makers, Li Auto specializes in plug-in hybrid vehicles, PHEVs, which can be powered by either gasoline or electricity. The hybrid powertrain compensates for China's sparse EV charging infrastructure and serves as a better gateway for weaning consumers off of petrol-powered cars. Macro environment. The macro environment also favors the company as China has had a resilient auto market in recent months, with a growth rate of 25.7% year-over-year in the sales of passenger cars in January, with high volumes pointing towards strong growth rates as EV seasonality exhibits more purchases in the second half of the year. Financials. In Q4 2020, Li had a 67% increase in quarter-on-quarter in deliveries compared to Q3. Based on this, the company estimates to deliver around 70,000 units in 2021. With the current seasonality and underlying trend pointing to strong demand, sales are projected to be 5 times higher in 2021, with revenues including services being around RMB 20 billion or $3.1 billion. Such revenue projects would put Li second, behind Nio and Xpeng, with Nio projected to reach 105,000 deliveries in a strong year, generating revenues of about RMB 35 billion, while Xpeng is projected to reach 65,000 units and revenue of about RMB 14.5 billion. Valuations. At current rates, Nio trades at 20.5 times 2021 revenues, Xpeng trades at 15.8 times, and Li at 7.8 times. Currently, Nio and Xpeng trade at a premium because of their technological prowess and planned European expansion. Li has the strongest margins of the group, with vehicle margins at 19.8% and overall margins of 13.7%. This is the reason even though Li had 60% of Nio's revenues, it had 85% of gross profits, attesting to strong margins on less volume. With expected strong volumes in the second half of 2021, margins could be around 18% for the full year. Capex is currently at 7% of revenues, but with a new planned model, planned Capex is expected to increase to around 10% of revenues. If the company can successfully leverage its margin profile to offset expenses from more R&D spend this year, it could reach $15 million in net income as a best-case scenario. With the improved margins and a breakthrough into profitability, the company could trade at around 11 times revenues, implying a 40% upside from current levels. Risks to consider. Aside from the pure competitive risks in ever-changing EV markets, supply shortages in chips and batteries on an industry-wide scale could threaten overall production growth, which could dampen expected delivery projections. Even with the largest domestic auto market in the world, China is particularly vulnerable to such shortages as it imports the vast majority of chips used in car production. Conclusion. Li Auto has built a strong foundation with in-house manufacturing and a focus on a single niche. By concentrating its product line specifically on premium SUVs, Li will acquire significant market share in the fast-growing SUV segment. Li Auto Incorporated's position as a serious competitor in the Chinese smart electric vehicle space has been established. Li Auto's future research and development spend will remain focused on the electric SUV segment of the market. In addition to the Chinese government's push towards EV solutions, the expansion of the country's middle class provides a constructive, long-term demand backdrop for Li. When it comes to the million-dollar question, is Li Auto stock a buy? According to 5 Wall Street analysts, 3 recommend a strong buy, 1 suggests a buy, and the other suggests to hold. None recommends a sell or a strong sell. The price forecast found on CNN Business goes over 13 analysts offering a 12-month price forecast. According to their rating, the stock has been steady since March, remaining the recommendation at a buy. Recently, Needham analyst Vincent Yu wrote that he is positive on the company's differentiation within the electric vehicle market. Charging stations might be common in and around major cities. They can be hard to find in other areas. Li has potential selling its SUV outside populated areas. What are your thoughts on Li Auto? Do you think they are a good investment? Would you buy their car if it gets available in your country? Let us know in the comments down below. If you made it all the way until here, thank you so much for watching. Don't forget to subscribe. It's free and reversible anytime. Hope to see you on the next one.